If you're an aspiring commercial investor looking to get your feet wet in the industry, you might be thinking, I don't have millions in the bank to buy these properties. And to be honest, I didn't either when I was first getting started. Traditionally, commercial real estate often requires a substantial down payment and a proven track record. Creative financing, on the other hand, can be your secret weapon to overcoming these barriers. With out-of-the-box strategies, you can control properties with less money down, sometimes even no money down. I use creative financing all the time, like this property here, or this property here. It's far easier to scale your commercial real estate portfolio if you're willing to get creative with deal structures, and I'm going to show you exactly how to do that today. First, we're going to talk about traditional lending. Then, how to learn about the seller's motivations so that you can properly pitch these deals to them, and I've also got a free script for you to download. Then we'll cover the different strategies that you can actually use to get creative on these deals. Of course, welcome to skip ahead to the timestamp right here, but knowing how to learn the seller's needs and what's motivating them, and then how to properly pitch these strategies is critical to being able to pull this off. So I do recommend watching this entire video. Before we dive into creative financing, let's chat for a minute about how traditional financing typically works on a commercial real estate deal. So picture this. You've found an awesome retail strip center that you want to buy, and it's about $1 million. In a traditional lending scenario, you'd march down to your local bank, portfolio in hand, and ask for a loan. Well, the bank, being the conservative folks that they typically are, might say, sure, we'll give you 75% of the property's value. It's pretty great, right? Well, hold on, because that's where it gets tricky, because that means that you need to come up with a $250,000 down payment. Plus, you'll need to jump through hoops to prove you're worthy of their cash. I mean, we're talking tax returns, personal financial statements, a track record of successful deals, and so much more. Now, for some investors, traditional financing works just fine. But what if you don't have $250,000 lying around? Or what if you just don't have the experience that they'd like to see? Well, that's where creative financing swoops in. Saves the day. Creative financing gives you a whole toolbox of strategies to structure deals in ways that work for both you and the seller. Maybe you can buy that building with little to no money down. Perhaps you can bypass the bank altogether and work directly with the seller instead. Now, let's dive into why creative financing may be the way to go. Many sellers are tired of dealing with banks and crazy interest rates, or want to avoid a hefty tax bill from selling outright. By offering creative solutions, you might be able to find a better transaction for the seller that other investors relying solely on conventional financing just can't. By thinking outside of the box with your financing, you're not limited by the lengthy approval processes of traditional loans or the need to save up large down payments between each deal. This means you can potentially acquire multiple properties in the same time it might take you to close on just one using conventional methods. Think about it. If you can control properties with less of your own capital tied up in every single deal, you can spread out your resources further and diversify your portfolio more quickly. This acceleration can be a game changer in building long-term wealth through commercial real estate. A seller might be seeking ongoing monthly income rather than one lump sum. With a well-structured seller financing deal, you could provide them with steady payments over time while gaining control of the property. Or perhaps a business owner wants to free up capital but continue operating in that same location. A sale-leaseback could be a perfect solution. By focusing on the seller's needs and using creative financing tools, you position yourself as a problem solver, not just another buyer. This approach not only helps you close more deals, but also builds your reputation in the industry, leading to even more opportunities down the line. At the end of the day, you have to imagine yourself on a fact-finding mission every time you talk to the seller. The more you understand about their situation, their reason for selling, and their true desired outcomes, the better solutions you'll be able to put together that can benefit both of you. Okay, now that we understand why creative financing can be so powerful, let's dive into the specific strategies that you can use to succeed in commercial real estate. All right, let's talk about the 5 steps to win commercial real estate deals. These steps are essential, whether you're using creative financing or not, but they're especially powerful when combined with the strategies we'll discuss later. Step number 1 is identify motivated sellers. These are property owners who have a compelling reason to sell, beyond just wanting to make a profit. They might be facing foreclosure, dealing with problem tenants, or simply just ready to retire. Remember, you're on a fact-finding mission. Ask as many questions of them as possible, and you can get that script here or in the link in the description below. Step number 2 is understand the property's financials and potential. Once you've identified a potential deal, it's time to dig into the numbers. This means analyzing the current and historic financial statements, understanding the property's income and expenses, identifying any areas where you can potentially increase revenue or decrease your costs, and assessing the property's potential for future appreciation. Don't just take the seller or the seller's broker's word for it. Do your own due diligence and create your own financial projections. This step is super important because it forms the foundation of your offer and helps you determine if the deal even makes financial sense and whether you should go the traditional route or contemplate using a more creative financing solution. Step number 3 is determine seller's needs and motivations. Now, this is where many investors fall short, but it's absolutely imperative, and you need to understand what's really driving the seller. Employ a little empathy. Are they looking for quick cash? Are they looking for ongoing income, more passive? Are they looking for the tax benefits or just a solution to property management headaches? The only way to really find out is to ask questions and, more importantly, listen to the questions that you ask. Build rapport with the seller and try to understand what their situation is fully. This information will be invaluable when structuring your offer. Step number 4 is craft a creative solution that benefits both parties. This is where the magic happens. Using the information that you have gathered from your fact-finding missions, it's time to craft a win-win solution. Now, this could involve seller financing, a master lease agreement, a sale-leaseback structure, or any combination of creative financing methods. The key here is really to align your offer with the seller's needs, while ensuring it still makes financial sense for you. Remember, the goal is to create a scenario where both you and the seller walk away very happy. Step number 5 is present your offer and effectively negotiate the deal. Now, this isn't just about handing over a document to the seller. You need to clearly explain how your offer meets their needs, highlight the benefits of your creative financing approach, and you'll need to be prepared to answer any concerns or objections and maybe show a little flexibility and willingness to negotiate when you get to this point. Remember, negotiation is just a give and take process. You both win when the deal gets done. Be prepared to make adjustments, but also know what your limits are. A well-structured win-win deal often comes together through a collaborative conversation between the buyer and the seller. Now, knowing these steps is just the beginning. Let's dive into our first creative financing tool, the master lease agreement. Now, a master lease is an agreement where you, the investor, lease an entire property from the owner with the option to buy it in the future. Essentially, you're renting the whole building and taking over its operation, while the original owner retains title and actual ownership for the time being. Now, think of it like this. You're test driving a commercial property before you buy it. You get to operate it, you get to improve it, you get to benefit from the cash flow, all while having the option to purchase it or walk away down the road if you like it or not. Now, there are 2 different types of master lease agreements that you should be aware of. The first one is a straight lease to purchase option. Now, this is the most straightforward version of a master lease agreement. Essentially, you lease the property for a set period of time, and you have the option to buy it at a predetermined price within that time frame. For example, I'm doing a deal like this right now. We're about to go under lease on it, where I am leasing the property for $4,600 a month, triple net. And at the end of the 5-year period, or even before the end of that 5-year period, I will have the option to buy it at a price that we already negotiated today. So if the property continues to appreciate, I'll just have that equity already built into it when I do exercise my purchase option. But it's beneficial for the current owner, but they get to lease it to one person and they don't have to worry about managing it or handling a bunch of different tenants or even dealing with the property. The second version is a lease with profit participation. Now, you might be wondering, what does that actually mean? Well, in a lease with profit participation, you are actually sharing a percentage of the profits with the ownership, depending on how you decide to structure that lease. This can actually be pretty attractive for both you as the buyer and sellers who believe in the property's potential, and they kind of want to benefit from your improvements. I'll give you an example of how I've seen this done here in Nashville. There's a co-working group that goes to churches and leases space from them, but they don't actually have to pay any rent payments. What they do is they spend the money up front to improve the property, then they'll rent it out as co-working space, and split the profits 50-50 with the ownership group. That way you don't have to actually come out of pocket as the tenant or future buyer, and they don't really have to come out of pocket either as the seller, and both parties get to benefit from a win-win scenario. As the buyer, you can control the property with little to no money down. You also have time to improve the property and increase its value before you actually buy it. And essentially you get to try before you buy, reducing your risk. If you decide you don't like the property for whatever reason, you finish out your lease and you walk away. If you're the seller, you actually get reliable income without the headaches of having to manage these assets. You can also defer any large tax bills that might come from a sale and stretch it out over time. And as the seller, you also retain ownership of the property. So if the buyer defaults, despite all of the rent payments they've made up to that point, you can basically kick them out, take the property back. Okay, now that we've covered master leases, let's dive into another powerful financing tool: seller financing. This strategy can be huge for investors who may struggle to secure traditional bank loans, or in an environment like we are today, where interest rates are simply too high to make a lot of deals make sense. Let's kick things off with the grandfather of seller financing, the seller carry first mortgage. Instead of dealing with a bank, you're making payments directly to the seller. They're essentially becoming your personal banker. You'll sign a promissory note, and they'll hold a deed of trust or mortgage on the property, basically like borrowing money from your rich uncle, but a little bit more official. Now, when should you use this? Well, if your credit score is not so great, or you just don't have the money to come up with traditional financing, and those bankers are giving you the runaround, it's kind of perfect for you, especially if you need to close fast or when a property is just too unique for conventional lenders. Now, pro tip, when negotiating, don't just focus on the interest rate. Talk total return. Sometimes offering a higher purchase price can get you better terms. Oh, and consider throwing in a balloon payment. It can make the deal a little extra tasty for the seller. Okay, now let's chat about the seller carry second mortgage, which is essentially the sidekick to your primary bank loan. In this scenario, you get your primary mortgage from a traditional bank or some other lender, but then the seller provides you a secondary loan behind that one. So it's perfect if you're a bit short on the down payment. We're typically talking about 5 to 20% of the purchase price here, which means you only have to come up with somewhere between 5 and 20% of the purchase price yourself. The interest rate on this second mortgage is typically higher than a primary loan, but still lower than you might expect from a mezzanine loan or a hard money loan. In the terms, they're often shorter, sometimes 3 to 5 years with a balloon payment at the end. However, it all comes down to what you're actually able to negotiate with a seller here. You might be able to get better loan terms with them than you are on your traditional bank loan. And the benefits? You can snag the property with less money out of pocket, meet those pesky loan to value requirements, and it's often easier to qualify, because all you have to do is have a conversation with the seller to see if they'd be willing to do it. But remember, if you default, the seller could foreclose, even if you're up to date with the bank. So keep those lines of communication wide open. Consider an elongated default clause for some extra breathing room as well, and it's important for you to fully disclose this to your primary lender. They need to know where the money is coming from, or it could put you in default of your bank note. Last but not least, installment sales. An installment sale is where the seller spreads out receiving their money over time. Why? 2 words: tax benefits. They can spread out their capital gains tax liability over the life of the loan, potentially keeping them in a lower tax bracket, which means less of that money goes to Uncle Sam. It's like turning a tax bomb into a series of less painful tax firecrackers. Here's another pro tip: team up with a savvy tax pro who can explain this to the seller. A CPA, a tax attorney, whatever that is, they could be your secret weapon when it comes to these negotiations. This type of structure is far less common, and they can get a little complicated, but in the right scenario, it could be your ideal option. All right, let's dive into another powerful creative financing strategy that I love a lot: the sale-leaseback. I'm actually under contract right now on a sale-leaseback deal I'm buying in Texas, and I love this type of creative deal. So what is a sale-leaseback? So it's a transaction where a business owner sells their property to an investor like you, and then immediately leases it back to continue operating their business in the same location. Think of it this way. Imagine a restaurant owner who wants to expand their business, but has all their capital tied up in the building. With a sale-leaseback, they can sell you the property and free up all of that capital that they can then use for expansion of their business and continue running the restaurant in the same spot as your tenant. Now, there are a lot of benefits to both the tenant and the buyer. So why would anyone do this? Let's break it down for both parties. For the seller, which is now the tenant, they free up capital tied to real estate for their business operations or expansion. They can also deduct rent payments as a business expense, not necessarily a motivator, but a pretty good reason to do this, and they maintain operational control of their location. For you as the buyer, you acquire a property with a built-in motivated tenant. You often get a property at market value or slightly below market value, which is always a good deal, and you start with positive cash flow from day one. It's truly a win-win when structured correctly. Remember, not everyone is in the commercial real estate business like you are, so they may not be as attached to owning the property. Now let's talk about industries where sale-leasebacks are pretty common. First, we've got retail. Think about single tenant net lease deals, fast food restaurants, big box stores, you name it. They love doing this because sometimes they'll go out and build the space themselves and then they'll sell it as a single tenant net lease to an investor. You've also got everybody's favorite child right now, industrial. Typically, these users have been in their spaces for decades and they end up having a pretty valuable piece of real estate that they don't actually need to own. So these are often great sale-leasebacks for you as an investor if you can find them. Of course, we also have healthcare, which is very popular right now as well, and kind of always is, because you'll have dentists, you'll have family practitioners, you'll have a lot of different types of walk-in clinics that love these as well. And last, but certainly not least, hospitality. That may be a surprising one, but if you're really good at operating a business, you don't necessarily need your capital tied up in the real estate. You might want that money to go expand and do a second location. Sale-leasebacks can be a powerful tool in your creative financing toolkit. They allow you to acquire properties with stable, long-term tenants while helping other business owners unlock capital for growth. Now that we've covered some of the more common creative financing strategies, let's explore a few additional structures that can help you take your commercial real estate investing to the next level. Know that these are just a few of the many ways to creatively finance a deal. First, syndication. Syndication is essentially crowdfunding for your commercial real estate investments. As the syndicator, you bring together a group of investors to collectively purchase a property that might be out of reach for any single investor. You want to make sure that you follow regulations and set everything up properly. You can learn more about syndications in this video up here. Up next, we have private money. Private money lending involves securing financing from individuals, such as family, friends, or investors that you meet at networking events, instead of going the traditional lending route. You can attract these lenders by offering competitive interest rates and solid collateral, often the property itself, but sometimes they do want your firstborn child. To further entice them, consider offering profit participation, which can provide better terms. Building and maintaining good relationships with your private lenders is, of course, crucial for long-term success. And then last, but certainly not least, assumable mortgages. These allow you to take over the seller's existing mortgage, kind of like a sub-2 deal in the residential world. This can offer benefits like lower interest rates, less paperwork, and a faster closing process, but it's not all rainbows and butterflies. Not all mortgages in the commercial real estate world are assumable, and you may need to qualify with the existing lender. Additionally, there could be a gap between the assumable mortgage amount and the purchase price, which means you will have to come out of pocket for that. However, it can typically be worth it, and I love assuming mortgages when possible. Implementing creative financing strategies in commercial real estate comes with challenges, such as dealing with seller objections and navigating legal and tax implications. To handle seller objections, educate them about the benefits of creative financing in plain language, and use real-life examples to illustrate your points. Address their concerns directly. Be patient and persistent without being pushy, and show how your approach can actually solve their problems. For legal and tax issues, build a reliable team of professionals, including a real estate attorney and a CPA, and stay updated yourself on regulations through seminars and webinars. Always think ahead to anticipate potential future problems and structure your deals accordingly. Overcoming these challenges will enhance your expertise and help you successfully use creative financing to achieve your investment goals. Distressed commercial properties are your best bet for negotiating the best creative financing solutions, so watch this video here on how to find them.